To all the viewers from the United States, Korea, and around the world, welcome to Global Money Talk, reporting from the floor of the New York Stock Exchange. I'm your host, Tai Wong, and joining me today is Jae Yoon, the Chief Investment Officer for New York Life Investment Management and Chairman of New York Life Investments Asia. Prior to New York Life, Jae was a Managing Director at Merrill Lynch and holds a Master's in Engineering from Cornell University. He is also a CFA charter holder. We'll be discussing Jae's thoughts on markets as we head into a closely contested election and the Fed embarking on an easing cycle. Jae, welcome back to the show.
Thank you. Nice to be here again.
Well, if you wouldn't mind giving us giving our viewers a quick brief on what it means to be the Chief Investment Officer of New York Life Investments.
Okay, right. So let me start with the company. New York Life is a largest mutual life insurance company in the United States. It is $750 billion in AUM, and it has the insurance entity, and it's a wholly owned investment subsidiary, and I work at New York Life Investments, which is a subsidiary, and we are about 400 billion plus. And we manage third-party money, as well as we do manage money for the parent, the general account, the insurance company. And we are located, obviously, multinational, but primarily in Europe and the U.S. And I am the Chief Investment Officer at the holding company, and we are multi-boutique model, where we have 8 subsidiary boutiques that specializes in all asset classes. Public, obviously, equity, fixed income, but we're also very well known for our private assets, private equity, private credit, real estate, etc.
You mentioned that you also, I didn't realize that you manage money, for other people, right, without obviously giving away any proprietary information. What kind of entities would ask you to manage their money?
Sure. I mean, it is truly no different than any other large asset manager that you host. We manage money from sovereign wealth, pension, other life insurance companies, all the way to retail. The average person buying a mutual fund. We have a mutual fund complex. New York Life Investment is the brand. So we manage money for the largest institutions in the world, all the way down to the individual, watching the show.
Right. And just one more question before we get into your thoughts on the markets. You mentioned private equity and private credit, and those names are sort of really big buzzwords. It gets a lot of play, particularly more private credit now. How active are you in terms of in those markets? There's a lot of concern about risk in private credit that might not be seen as much in as they are securities.
Unlike public equity and fixed income, which is traded, by the minute, right, by the second, private equity or fixed income or credit, it's not tradable. It doesn't mark to market. Of course, we have marks at least quarterly. But other than that, you might not see a mark if you're a client. So in that sense, you're right. And things play out slowly. And sometimes by the time you find something's not working, it's too late. The commitment in private equity and private credit is really over multiple years. In private equity, it could be 10 plus. In private credit, it could be 5-7 years. Okay. That's the commitment. Now, these days, obviously, with retail interest and high net worth, there are products, that trade similar to closed-end funds. For example, BDC. Okay, there's probably like 50 BDCs that's trading in the New York Stock Exchange or with a ticker, and they're technically most similar to private, to closed-end funds, or maybe you could compare them to REITs in structure, and you can trade it intraday.
And are they pretty liquid? The spreads are reasonable?
It's highly liquid, obviously. I see. In that sense, a bit offer. Yeah, it's reasonably liquid. However, again, when you provide, now we're getting very academic here, but when you provide an illiquid asset class and package it in a very liquid vehicle, it can be very one-sided. When things go well, it'll melt up. When things go badly, it'll melt down. And there is an underlying NAV, what it should be worth, and then where it actually trades. So some of the more sophisticated investors that are watching probably play this during drawdowns or recession. These assets, because there's a run from the asset or the product, what you can sell it for will be a lot lower than what it's worth. So when that's called trading at a premium or a discount.
Sure.
So in such a moment, for me personally, when it trades severely discount to NAV, it's potentially a buying opportunity. You do have to be careful. When it goes down, let's do like 08.
Okay, sure.
You know, or 08. When it goes down, it's severely discounted, but in that instance, now that we're looking on hindsight, it kept going. And so the right thing to do of that then is not buy the dip. You needed to let it like bleed dry. I don't know if that's a little aggressive an analogy. Let it
not at all.
Let it all bleed dry. At some point, and this is the market timing that's not easily done. In fact, I wouldn't even try to market time. When it's just severely discounted, and when you feel like the economy has really hit the bottom, when you're most, as Warren Buffett says, when you're most scared, is probably how you know it's the buying opportunity. Then you would, if you bought, you would have not only made the rally back, you would have made extra because you bought it at a discount. The more recent example is 2002, 2003, only a year and a half ago. We had a little bit of like, is recession coming or not, right? So a lot of riskier credit had a drawdown performance. These BDCs had a much more severe negative return or opportunity to buy. So sometime in 03 when it was realized that probably we're not heading into recession, at least not yet, maybe next year, which is now, or maybe further out, and it traded maybe 20% discount to what it's worth. Again, another buying opportunity. So in moments when liquidity is desired, meaning people are selling or buying, you have to be a little bit careful because you're not paying for the asset's value. You're either overpaying because everybody wants it, or you're getting it cheap because nobody wants it. Okay?
That's fascinating.
So you do have to be a little more sophisticated to play the discount game.
And patient, because sounds like there's not always an opportunity. Yeah. You have to wait for when the market
so I'm more of a value investor. I look for things that are fairly cheap. These days, value is not a very good game to play. Last couple of years, it's been all about momentum. Ride what's working and just keep riding it.
Right. Just one more quick question on these private credit, private equity.
Yeah.
Certainly with those kinds of lockups, and you mentioned 8 years, 7, 8 years for credit, maybe even longer for equity. For you to be interested in it, is it really diversification, or is it diversification and additional enhanced returns, or a combination of the two?
It's a great question, and it's all of the above, right? So I go back to retail again. If you're retail, for whatever reason, you want a lot of liquidity and you want to be able to get out when you want. There's a price to pay, and we talked about, price could be an opportunity for someone like me, right? If you're an insurance company or pension or someone with a very long horizon anyway, that's your mandate. You really rather not play in this public BDC and get the price whipping around that away from NAV, right? You actually would rather be locked up or locked in for a long period of time. Not that you care to want to be locked in, but if that lock-in comes with stability, then you'd rather be locked in and have stability because you don't need that money. If you're a pension or life insurance company, your liability, meaning when do I need that money back, typically is 10 to 20 to longer.
And it's probably pretty smooth based on the actual.
And you'd rather have a smooth return profile. You don't want the thing bumping around just because you may want to take the money out, because you don't.
Right. And just pursuing this just a little bit, a lot of university endowments in particular seem to be, over the past 10, 15, 20 years have gotten heavily into sort of private equity.
That's right.
And some have done a lot better than others.
That's right.
I think my alma mater hasn't done very well,
Right.
or on a comparative basis hasn't done very
Right.
well. So are these appropriate?
Yes.
They're I guess investments for these endowments, because some of them have put a lot of money into these.
Yeah, so you asked actually two separate questions. Is it appropriate for them to invest in these asset classes? Absolutely. There is what we call illiquidity premium. Private equity and private credit tend to have an enhanced yield and return to public. And we won't get into it. Again, just have to a little bit take my word for it, okay? So yes, it's appropriate. Where I agree with you, is it appropriate question should be asked is some, not all, select few, let's go with few, have actually, because of its attractive return profile, put maybe too much money. Because don't forget, you're locked up for, like I said, 5, 7, 10 years. So in that sense, you can't take 100% of any portfolio, no matter how long-term your liabilities, and just lock it up, right? So, we can debate the right proportion, but, maybe third, I could go, yep, that makes sense. But to your point, some have just bought more and more and more in terms of allocation. At some point, you go like, it's like you don't know what's the right number, but you know what's the wrong number.
Absolutely.
Oops, that's a little too much, right?
Would you, and I just want to pursue this a little bit more, because your insight on this is really, really good.
Yeah.
In terms of private equity, they had sort of a heyday, I suppose, when rates were very low and there was sort of a lot of value. But rates are high, perhaps on their way down, but perhaps not back down to where we got used to 10 years ago or 5 years ago. And valuations seem to be quite high. Is it just getting much harder for private equity folks right now?
Yeah. So because I'm an asset allocator with a long-term view myself, a lot of what I do even for when I trade stocks or buy publicly traded instruments, I tend to invest with longer horizon. So I do call myself, in the turtle and the rabbit story. I'm the turtle. I go for the longer term return. Whereas many investors, especially in retail, are looking for a very short-term trade. So using that framework of 5, 10-year horizons, incremental horizons, as you said, since 2008, Fed had, in trying to create inflation, remember in the U.S. has had long and hard effort to try to create inflation since 2008. And for longest time, the Fed kept interest rates extremely low. In fact, global central bank in developed countries kept interest rate extremely low to try to create inflation back up to 2%. Obviously, we had obviously in 2002 we had a spike up to 9 on CPI, but for longest time, what that does, so private equity has an inherent leverage. So I actually tell investors leverage is bad, shorting is not a great idea. In retail, you're leveraging near term, but private equity actually is able to leverage the entire period, what I call term leverage. Nobody can call them out. Right? Their borrowing is extended with a longer term horizon. In this kind of term leverage, which is less risky leverage, private equity can borrow at a very low interest rate environment in the last 15 years. And then private equity, by definition, is a levered instrument. Just like real estate. When you buy a home and you put 25% down, you're technically levered 3 times, right?
Right. That's why Asians love it so much.
Or 3 times, 4 turns, however some people express it. Private equity is exactly the same concept. They borrow from private credit folks at very cheap interest rate last 15 years, and then they buy private equity on a levered basis, not dissimilar to buying a home. There, the bank doesn't go, you're levered, market's bad, we want you to unlever. That doesn't happen to a home. Same thing, it doesn't happen to private equity. However, the leverage that I don't like, they will do that, right? You have a brokerage account and you lever, you create a margin account and you lever. There, if markets start to fall and you're being marked to market every day and you get over your skis, your broker will call you and say, you hit the margin call, sell your equities, give me my money back, right? Right. That happens in what I call bad leverage public market, where you shouldn't, I recommend investors not to do that, or at least not to do a lot of it. In private equity and buying a home, you have a term leverage. And that's why private equity actually enjoyed that free borrowing, I'll call it, right? Near zero borrowing to be able to buy equities that's done well. But when it goes well and you're levered, your returns are 3-4 times. That's the benefit of private equity. To your point, going forward, interest rates are likely coming down from here, Fed's cutting, but I don't know if you introduce your investors to the neutral rate. Where does Fed think would be the rate at which it's not actually restrictive or easy? That's called Rstar, and that number historically has been 2. There's a huge debate whether it should be 2.5 or 3.5, and most of us just say let's go, in the middle and call it 3. Fed, as they cut, will likely, if it gets there, will get there, but not much more.
Right. There's been a lot of talk about this R-star. The market doesn't know, and the Fed doesn't know where it is. But it's a good point that you'll probably know once you get there. And I suspect a lot of economists think that it's going to be higher, or strategists think it's going to be higher.
If that's true, then private equity, when they borrow from private credit, there's a spread over R-star, so for rate, and then you're probably going to borrow at a much higher rate. Therefore, you won't get an easy, cheap leverage.
So the game is changing a little bit. At least certainly it appears to be in the medium term.
Sure. When we say games changing, I think I just need to be clear to your viewers that when you get cheap borrowing, you can probably enjoy a higher return. When the borrowing cost gets higher, you will still enjoy return. You just have to manage your expectation. So I'm going to pivot back to public equity. It's the same thing. In public equity, we measure valuation in many ways. One of the measures is price to earnings. Historically, America has had a price to earning ranging from 14 during recessions up to 1920 being expensive. Remember, we're in a new norm where a lot of brokerage strategists are telling me the new range is 20 to 25. So we are around 20 to 23 on price to earnings for S&P 500. 10 years ago, you'd be like, that's way expensive. Today, many people have convinced themselves this is the new middle of the range. The new range is 20 to 25, and we're right in the middle.
It's amazing. It's like sort of changing the goalposts as we go along.
Right, to justify where you are. Now, you are finally seeing many long-term strategists, whether it's JP Morgan, Goldman, let's reference them. Dave Costins, who's probably well followed, have come out and said the next decade, it's easy to make long-term projections. Well, it is. Not because no one can call you on it for 10 years, but long-term, it works with law of averages, right? And he said, manage your expectation on U.S. equities, because relative to the rest of the world, U.S. valuation is at super extreme level. So expect single digits kind of return is what he's saying, right? And so to me, our conversation on private equity borrowing costs, manage your future returns, it won't repeat what you enjoyed last 15 years for the next 15 years. I think it's similar to what the PE concept for public equities. Valuations are at a high level, borrowing costs were really cheap, and it's not the same game the next 10 years.
That makes a lot of sense. So, shifting back to, we wanted to talk about some of your best trade ideas, your trade ideas that you think are now, for now. 2 months ago, when you were on the show, we were just a few weeks away from the flash crash, and now we're 15% higher in the S&P. A couple of little consolidation maybe over the last couple of days, but right off the on the highs, and we're heading into a closely contested election, as well as the Fed starting its rate cut cycle. So, in terms of keeping those things in mind, what things are you looking at now? Where are there some good opportunities? Sure.
So it's interesting because it's very distracting here, but I give it to you. You do this every day. Let's see. let's go with public equities,
Sure.
and we'll do a quick run because nothing much has changed there in terms of my view or the market itself, right? We've had some fantastic corrections, I think, since I've been here and then rebounded. So let's go equities, U.S. first, right?
Sure.
U.S., I think that it's similar game in terms of valuation level. It's expensive, as we talked about. However, we went from, is it a soft landing or recession 2? We're now looking at, is it soft landing or no landing, and should we be worrying about inflation restarting or creeping back in? And therefore, Fed may not cut much. And so in this regard, we've actually had in the last 2 weeks, interest rates start to peak higher because of that, right?
Right, sure.
And so I think equities had a little bit of a downturn, and today we're getting a break from Tesla, I guess, earnings numbers. I still say this. I find the large cap, especially growth tech, expensive. But we know, as I travel to Asia, to anywhere in the world, the retail, around the rest of the world only know like 20 stocks in the U.S.
Right, right.
When they say we like American stocks or U.S. stocks, they're not talking about the S&P 500. They're talking about like 20, 30 stocks that they know. Okay? And that's all they buy.
Right.
I mean, I'm exaggerating here, but
you're largely right.
Yeah, that's the focus. So I myself have been shifting money throughout the year, but it got quite strong, the view, to move away from large to mid and to lesser extent higher quality small. And I have to be very clear about that. Because the valuation in the US is expensive in the large growth because people will keep buying the tech stocks. Because to be fair, in the last 10, 15 years, they've proven themselves worthy. But now the valuations are even more extreme, and they're a much bigger company than they were when they were actually moderate company where they could actually move the needle on their earnings potential, right?
Right.
Today, they're quite large now, finally. And for them to actually keep growing at the same pace, it's just become that much more challenging. And yet, people are like, hey, it grew at this amazing pace last 10 years, so why couldn't it grow the next 10 years? You know, I don't want to get all academic on people, but, you know, 100 going to 200 is easier than 200 going to 400 is easier than 400 going to 800. You know, doubling gets more exponential in concept, okay? Now, so who knows when something that feels like a bubble, maybe it's not a bubble yet, but very expensive, who knows when these things turn into a bubble and when does it pop? So for me, I think it's like as a long-term, as a turtle of an investor, it's time to start shifting money. So I'll tell you, like, you know, at these levels, history tells me you should get out of equities. But I'm not. I do some market timing, but I don't dare to market time that extremely. So I'm shaving, right? I'm taking some chips off the table in the large, moving it to middle. I feel very comfortable with middle market, right? In public equities. Small, I just have to caution you. If I go ETF, I'll go to S&P 600. I will not buy Russell 2000.
And why is that actually?
Okay, here's again. I have to like now get a little analytical on your investors.
Please do.
Okay. So if you look at S&P index composition, I'll go really fast. It goes large is defined as S&P 500, the top 500 stocks. Then mid cap is the 400, S&P 400. So we're talking about 900 stocks. The small is S&P 600 below that. So from top to the low end of small, you're talking 500, 400, 600. Okay, that's 900 plus 600.
So 1,500 stocks.
Yeah, 1,400 stocks. Thank you. When you get to Russell large is mega is the 200 top. Russell 1000 is large and middle. So you start with the 1,000 being large and middle. Then the small is the 2,000 stocks below that. So you're already way below where S&P 600 is, right?
Okay, I see. I don't think that's a really important distinction, because when you
Sure.
say small cap, people say, oh, let's do the Russell 2000. And you don't realize actually the Russell 2000 is actually, say, very different
Extremely
than the S&P 600. I wasn't even aware if there was such a thing as an S&P
Right.
600.
And when I was here last time, I think I was here last time mentioning the 40% of the companies in Russell 2000. Okay, that's 800 companies out of 2,000 don't make money. Okay,
Wow.
they're not profitable. Someone mentioned to me earlier this week the number is now 60%. I didn't fact check that yet. The 40% was told to me by my quant, who fact checks everything he tells me. So let's say 40 to 60%. Let's go half.
Half. Fair enough.
Right. That's a large number of companies not making money. Now, because we're in an up market, Russell 2000 likely going to outperform on an up day. On a down day, or on a, let's say Fed's not cutting enough, maybe small caps are not going to do as well day, it will really get drawn down. So I say stay with S&P 600 ETF if you're going ETF, and don't do Russell 2000. However, I like mid cap the best, and we are adding to small cap.
Okay, so let's look at graphic 3,
Yeah.
because we
Yeah.
prepared a comparison between the S&P 500 and the 600. It's actually pretty interesting. I apologize, because the red is a little hard to see, but you can certainly see the yellow is the S&P 500 over the past year, and then the red you can see certainly a divergence. So I guess, Jay, that makes it's a pretty good, seems to be a good time to sort of take a little bit of a few chips off the highest performance and putting in the little on the lower.
That's the concept, right? Clearly, if you look at that chart, S&P's outperformed, but from middle of this year, I think equal weighted and mid cap actually started to outperform the large. Okay, but again, not by much to say, that was a better trade, but it's starting to shift.
So when you're looking at the shifting into, looking for the S&P 600 to outperform the 500, over what time frame roughly would you be looking for?
Oh, right. So next year, I mean, it would be meaningful number like a year. But again, you remember, it's a momentum market. What that means is things that work will continue to work until a day it doesn't work. Okay, so I'm going to date myself back to 2000. Again, Bernanke in 1997, who was the Fed chair at the time, said irrational exuberance, referring to the NASDAQ. And since he made that comment, the NASDAQ outperformed rest of the market for another 2.25 years. At which point, the NASDAQ dropped 80% over the preceding 2 years. Now, just in 2000, that 1 year when it started to drop in March of 2000, the year 2000, the growth index, I remember it that way, which is composed mostly of NASDAQ, was down 20-some%. The value index, which, like in the small cap example, which was left in the dust for the prior 2 years, went up 20%. Okay, if anybody remembers the year 2000 and look at S&P, it wasn't a great year, but if you're in the value index, you were actually up when the growth guys were down. So you outperformed the value guy, the growth guy by 40%. Yet, leading up to that, decisive moment, you were lagging behind, like in that chart, lagging. I don't know when this flip will happen, but all I can tell you is since the summer, this trade's done fine and might actually have a slight edge. Maybe not the small cap, but my mid cap and equal weighted. But at some point, the valuation in mid cap and small cap is much cheaper than large cap. But these days, when momentum drive trading, people don't look. Some people that buy these 10 stocks, 20 stocks, if you tell them that's the PE of the companies you own, they're like, what is a PE? I'm not saying they're not aware, but I don't think they care is my point. Right.
You're absolutely right. I mean, my father-in-law actually is, he's well in his 80s. He's a big investor. He's into tech. it just goes up. I'm like, well, and we've dated ourselves a little bit, and I'd say to my mom, we've had companies like Ron, they don't always just go up. By and large, you've done very well, and you're right, so I'm not going to tell you you're not.
Exactly.
But certainly, I think this is a solid idea. Now, if some of our viewers wanted to trade the S&P 600 and the 400, is it just the ETFs? Is that the best way to do it?
Well, so, there are some that would argue small cap, you have to be more selective. I agree. If you want to trade the Russell 2000, you better hire an active manager who's selective. I think S&P 600 is fine. And if you're a more conservative investor, there is an S&P 600 quality in the ETF.
Oh.
Even within S&P 600, there are some that will quality tilt it. So if you're going to go passive and you're concerned about some of the comments about earnings, etc., you can then even find an ETF that selects even finer, filters out the the negative earnings companies, even from there. So yes, you can do ETF safely in mid-small. Mid you can do safely, period. Small if you want to get even more quality. But again, when you do that, the returns will be even lower, right? Because you are going with high quality. There is a benefit if you know what you're doing to picking the low quality stocks, because there you're looking for a turnaround of that low quality companies that actually is turning. But if you're a passive investor, I think you can afford to give up a little bit of excess return by staying quality, especially now.
Makes a lot of sense. Yep. Now, one of the trades that we talked about before the show that you liked is on the fixed income side is TLT. Can you tell us a little bit about TLT?
Right. So I think last time I was here, I still owned it. So if you look at TLT, just last year, just to show the run and the run up and drawdown. Remember, in fourth quarter of last year, we had interest rates. The U.S. is continue to spend, and therefore the borrowing cost should be higher, and investors were demanding higher real yield above inflation. So you remember 10-year as a proxy, yields were going from 4.25 all the way. It ran all the way up to 5, and then Yellen, in her own, trying to manage the borrowing, shifted our borrowing from notes and bonds, which pay coupon, to T-bills, very short end. And all of a sudden, the supply in the 10 years and beyond, up to 30 years, the supply or the need to borrow went down. It's not because all of a sudden U.S. government became fiscally responsible. They shifted the borrowing. Okay, it was a bit of a head fake in borrowing, right? Not head fake. I'm sorry. She mindfully managed that. Okay, and then all of a sudden the yields came screaming down to even the wildest surprise of many that says there's no way this is going to come back down. And you actually went all the way down to where he started the run. Okay? Then we came into this year, we were well managed in interest rate. And in April, we had a very strong inflation print within the GDP of first quarter. That's when 10-year yields went shooting back up to 478. That's when I bought. See, I like to be a contrarian, so I like to pick stuff up when things look cheap. So when I bought that, I remember saying, and I know we did talk about it here a little bit as well. I think the end of the year bond yields will get to 4.2, maybe early next year 3.8. I was expecting at that time slowdown and possibility of fear of recession still lingering with us. Then about a month, 2 months ago, probably the recession fear was still top of mind for many. Bond yields got to 3.5, 10-year bond. 3.5. We went from 478 to 3.5. I got out at, I forget, like 3.9. When he broke 3.9, I think that I got out. And then this thing kept going, and I'm like, wow, it's crazy market, right? When you make certain view about, I think this is probably where it's over, and then it just keeps, again, bonds have momentum as well. So that surprised me that it almost touched 3.5. And then what happened since? we start creeping back up. And then 2 weeks ago, the rumors started maybe this, Trump's going to win, and everything started to move from Harris preferred trade idea to Trump preferred trade ideas. And then the 10-year bonds, here we are at 422. And I'm told by
just where you said it was going to be.
Not the way I thought. So
That's okay. You can take the win.
All right, fine. But we're not at the end of the year. But I can tell you, it'll be anywhere but that 4.2. How about that? So the point that I actually picked some up. Okay. The reason I picked some up is I think the Trump trade, we will know next week. We don't have to wait long for it whether it is going to keep going or not. A lot of technicians tell me this is a technical resistance. So I picked some up with a intuition, which is not worth much to anyone else but me, that this may get to 4.5, and if it breaks 4.5, it will try to make a run for it, right? Okay. Meaning head towards 5. Will it get there is a different matter. So the reason I bought some anyway, realizing that if we get to 4.5 and higher, I'm going to be down on this particular trade. I like to buy these type of mean reverting asset, that's bonds and currency tend to be mean reverting. I like to buy them in increments of 3, 4. And last year actually I bought and he kept going back up. I think I bought it like 10 times. Meaning I have conviction that it can't go on forever. Unlike equities, which can, right. Bonds and currencies don't. You can't run forever, okay?
It's sort of, I think of bonds as sort of like a rocket, and eventually it succumbs to gravity and falls back. But let's take a look at let's take a look at graphic 1, which is a chart of TLT for the year, so we can get a sense, for the viewers can get a sense of what we're looking at. So that's a TLT ETF, the 1-year chart. And actually, if you don't mind, Jay, can you just explain exactly what is in this ETF?
Yeah, so we talk. A lot of market participants refer 10-year as a benchmark, and we talk about the 10-year yield, and that's what we just did. Right. But TLT is a U.S. Treasury bonds, but with duration, with maturity that is 20 years and longer. So it doesn't even include the 10-year bond, right? Right. So TLT is all U.S. Treasury issuance with remaining maturity over 20 years. So it's got extremely long maturity. So really, we should be talking about 30-year bond yields when we talk yields.
Fair enough. Hey, let's look at a graphic too. Yeah. So I did a TLT 5-year chart just to give us a little bit of more perspective. Yeah. And you can see that we're pretty near the bottom. So I think your idea about buying in tranches, maybe a very good one. Your downside seems to be certainly here in 5 years since the pandemic. Pretty limited, and there's quite reasonable upside.
I mean, listen, if you pull up 20-year chart, it's been coming down for the last 20 years, because 20 years ago we had similar issues. Inflation was abundant from the 70s, right? And then you had the over excessive U.S. government borrowing, and investors, and we used to refer to them as bond vigilantes, demanded higher real yield. Real yield is the yield they demand above inflation cost, okay? So a bond's yield represents the inflation piece, and real yield, meaning the extra premium they want. Now, during this backup, a lot of us are watching the real yield band range. And what we're realizing is investors are demanding higher real yield. That's what's happening. Inflation hasn't moved up. Inflation's been, incrementally bouncing around a very stable level the last few months. Yet interest rates go up. That's really real yields going up. And so real yield in the past few years here, or maybe even longer, for that matter, maybe past 10 years, because we have to go all the way back to the zero interest rate environment. Real yield's been below 2%. It hasn't broken that 2% band. Once it breaks, a lot of people fear we're back to the 80s.
Right.
Back in the 80s, real yield was 5%. Interest rate levels were higher, so you have to do it in percentage terms, right? When you have 10% yield and 5% premium, that's still a third or half, depending on how you want your denominator to be. So All I'm saying is, if we have a 4% yield and 2% yield premium, that's exactly the same percentage, isn't it? I'm a bit of a math geek, so
Right,
there
sure.
you go.
Hey, you're an engineer.
There you go. So the 2% is probably right percentage rate. But if yields head higher and real premium is demanded, then yields I can easily make an argument for why we should be at 5% yield today.
Right. Now, I guess to our viewers, the way I think about this is that basically you're buying a 25-year bond when you're buying TLT. Now, the 10-year is the benchmark. Why do you like TLT than maybe trading like U10, which is sort of like the 10-year?
Yeah, even though I'm only trading the bond market here in this example, I'm a multi-asset manager in my portfolio. Not only in my personal portfolio, in my professional portfolio, we have equities, we have some currency, limited amount, and we have bonds, okay, and commodities, etc. So in order to compete for volatility with equities, I can't buy the 10-year or below. Bond market, when interest rates move, there's a concept of duration, and that determines volatility. With a 10-year bond, when interest rates move, it doesn't move enough in price. I need something that moves with a little bit of oomph to compete with volatility of my equities. TLT has a duration of 17.5, so when interest rates move 1%, let's go 10 basis points, you'll move 1.7%. So now you're in the same range as equities. Okay? I even trade, now I'm going to go with PIMCO. I'm not advertising iShare or PIMCO, but they have an even more aggressive version. These are very dangerous animals, right, once you get out there. They go 25 plus strips. Their duration is 25 or even longer. Now, when 10 basis point move, okay, 1/10 of 1% move in interest rates, they will move 2.5%. Now, you're looking at something that might be more volatile than equity on a given day, right? On a given day.
I guess it makes sense when you're allocating sort of vast sums of money. You do need to move. You need to have the opportunity to be able to make money. So that does make a lot of sense. TLT is a pretty good investment in that case. I want, before we shift to actually Japan and China, you mentioned something a little bit earlier. You said the Treasury Secretary sort of shifted the borrowing from longer term to shorter term. Do you think that was really with a desire to bring longer term yields down, or or was it just the timing of the borrowing?
No. My mind, okay, I don't talk to her. My guess is she did it purely to stabilize. I go with stabilize, right? Because she knows the U.S. government, the president, current president, wants to keep spending to get the economy going or continuing. So in order to facilitate his spending habits, she had to stabilize yield levels. And by shifting to the left or to the T-bills, it would stabilize and continue the borrowing. So I'll finish with this comment. The equity market is such a run. The government of the United States, now China joined the party, keeps spending. And many countries are trying to keep liquidity very high and spend or make it easy to borrow. And that has fueled the equity market and the economy itself. Okay, equity markets are crazy. Economy is stable, so equity market wants to keep running. What will stop this momentum trade? I think it's not Middle East war, because those are probabilistically, I don't see it escalating to a point where it's going to disrupt the market. I say 5% yield on 10-year bond, and it gives you the fear that it might not stop there, right? Because if it runs to 5, and it's going to give a lot of fear that it's going to keep going, even though it might stop. And that's what's going to disrupt the equity market. And anybody who doubts me, it happened this week.
We're going to buy our last tranche of TLT right there.
Well, so my point is, this could be the resistance level, and it'll stop. Or it could get to 4.5 to 5. Part of me says if I have to, if I had to force a decision out of me, I say I'm prepared for it to go to 4.5.
Okay. So, I'm cognizant of the time, but we're having a great conversation. Since you were last on the show, we've had a huge sort of firmament change, or at least appears to be so, in China. So, what have you done in China?
Yeah, yeah.
What are you thinking there?
Well, so, we talked once back then. I was in Asia, Singapore at the time, and I made a call. This was about early September, I don't know, first week, second week of September. I made a call that I've been saying for over a year now that Chinese government needs to do fiscal, and they keep dripping fiscal. And we know fiscal can't be dripped, or at least if you want to impact the market and turn animal spirits on, you have to bring out the bazooka, okay? You can't be, well, as we call it, pea shooters don't do that, okay? And they've been pea shooting, the Chinese government, and when they reduced the triple R ratio down, and it was hitting like 20-year historical lows, and with plans to keep going, something in me knew that obviously I knew that there was a Politburo meeting, a 1-week break, and they come back. And a lot of the strategists, people that follow China, are telling me that in December they have to go with the bazooka. Bazooka's coming, bazooka's coming. But when they started to accelerate the cutting of the triple R, I felt like, what if they do it before? This thing is going to do like the bazooka shock and awe. And so I actually, we professionally told my team, hey, I'm going to make a call. I usually don't override or do anything. My team does a fine job, but sometimes in a situation like this, I make a call. I say, guys, I think we've been for a long time have a benchmark of emerging, but we've been investing in emerging ex-China. We didn't like what was going on, and we still don't quite like what's going on in China broadly. But I wanted to make a call and take my profits, if you want to call it that, by underweighting China and beating it by not underperforming with it. I said we need to buy the entire emerging again, meaning we need to buy back China. And I would like to buy something in China in case there's an early surprise. My team felt like buying Chinese equities, what if we're wrong? It's hard to justify given our mandate. Even though we own emerging as a mandate, we buy China. So we closed our gap by buying back China in emerging, and we bought some Hong Kong. I personally bought everything. What I mean by everything is I bought Hang Seng, I bought the K-Web. K-Web is an ETF that is not just broad China, but it's the highest beta China. I called the broker, I said, what ETF has the highest beta? K-Web is basically internet stocks of China. And then I bought the broad CSI 300. I bought all three. Then I bought, and this is where I give you some credit, I bought some all commodity. I specifically bought agriculture, metal separately. Beyond all commodity has all that. I traded gold early, bought it at 1750, dumped it at 2200. I'm still bitter about that. So Ty, I remember our conversation when I was here last time. You were convincing me about, bought track, palladium and platinum, which hasn't done well. And I'm like, in one of these all commodity rally, they were left behind, so I bought those two in meaningful size. And palladium must have known we were meeting today because it gave me a big gift overnight, as you know.
I know.
And I'll let you talk about it. Yeah. But why? You tell.
Well, so as an old palladium trader, basically the Biden administration has has proposed that we put some limitations on the Russian export of certain metals like nickel and palladium. Palladium is a small market, and it's almost used purely in catalytic converters. And in a small market where Russia is a big, maybe 50% supplier, maybe more of the the planet's palladium, that's gonna make a mark.
Right. So then, just to close the loop, because I want to explain the trade. Yes, I bought it, so I got it in early, and I had some other limit orders because I always like to buy multiple. Never got to buy multiple, right? It ran up. So from where I bought, just looking at the China trade, K-Web such, they were up 30-35% from where I bought. Hang Seng was up 20, but I knew, and Korean investors that watch other shows where I do it in Korean will have heard this. I knew as he was running up, this is not going to just go straight. Okay, nothing goes in straight line, unless you're the Magnificent Seven. So there's going to be fits and stops, and it already has a couple times, right? So I have to give up the limit order back. I should have just bought a lot then. This thing ran up. I knew it was going to hit some peak, and then it's going to, like, a bunch of people are going to doubt China, and they're going to sell, sell, sell. So I told the investors that when it breaks down below, and I said about a third to a half I'll buy, and then 2/3 I'll buy again. For KWeb and the CS 300, it already went down to close to 60%. So I actually bought it twice more, whereas in Hang Seng never quite corrected as much. Now, why did I buy more? You know, I should have just bought all. Yeah, because you don't know, so you actually try to divide up your trades. That's what institutional investors do. We don't try to market time buys and sells. You leg in and you leg out, right? So I missed the leg in. I didn't realize how impactful that rally would be. My shame. So I bought more. Why? I think the Chinese government is trying to be a little bit too cute because there's an election ahead. They don't want to put, shoot all the bazooka and then find themselves like, last three big bazooka moments, the market runs up for 6 months and gives it like a lot of it back, right? We've had these fits and stops 3 times in the last 15 years. When the bazooka comes out, it doesn't last long. So I think they're trying to be cute about how they implement, and to be fair, they have a real problem to fix, right? In real estate, housing, lack of demand by savers. Chinese consumers, unlike the US, let's be honest, they have money, okay? They're savers. They're like forever savers, okay? But how do you get these people to change their habit? In America, you turn an animal spirit, we're happy to spend. We want to spend. The Chinese are not, right? So I think the Chinese government has to stroke animal spirits, but in a slightly different way. So what I'm trying to say to you is, I don't think structural changes are going to happen. I'm not that positive on China, but I do think next 3 to 6 months, this thing is going to move higher. And at least the floor said, if I'm wrong, I'm not going to lose. I don't see the possibility of losing a lot of money. In fact, I'm like so far in the money now. I know it's hard to. It'll take a lot for me to lose my money. But my point is, for even if you're looking at it here and now, I think there's going to be another 30% move easily, maybe 30 to 50% move easily left. Again, but don't expect a smooth ride. It's going to be a bumpy ride.
They still have to show us that big. They've hinted at the bazooka. Yeah. We see it under the covers, but we actually haven't seen them take it out yet.
Well, how about this? Let's just go with the next 30 days, okay? They know if Trump wins the election, if it's going to be bad for China, right? In terms of investor sentiment. Yeah. What actually happens, who knows? The immediate move will be, okay, Trump's elected. He's going to start attacking China with tariff, etc., etc. You don't think they're ready for one more round of? They're going to have bazookas ready to shoot, okay? And a bazooka will, I believe that.
So it sounds like the bazooka is going to be there, and it may be another one of those episodes where we get, sort of a 3 to 6 month big surge, and then it starts to peter out again.
I don't know if it's going to be a big surge, but all I'm saying is I see it going higher, but in a very uneven way.
Yeah. But that was a great call. I mean, if it was any better, the DOJ might have to ask what did you know and when did you know it?
Well, you gifted me the Palladium tree. So.
And we're starting to run a little short on time, and I want to get to Japan.
Yeah.
You're very interested in Japan. You look at it very closely.
Yeah.
What are you thinking there?
Well, Japan is structurally improving. So we talked about this on the last show. Last April, I bought Japan equities. Unhedged, but I actually cut some of the position when I thought the yen rallied too much, because the rally in Japan is structural improvement, so it's real, but plus the currency giving benefit to equities. But when it hit 160, I felt like the currency is going to come back down, so equity will have to give back some of its rally that's due to currency weakening. So that turned out to be a good guess as well. look, these things, when you're an investor, you have to make some projection. You have to have a guess, educated guess on what might be happening. So at this point, here and now today, I still am bullish Japan and have a open position, positive, but not as big as last April. Currency, we got a gift when that, the carry trade unwound. We got out. In fact, we got out in 2 increments. You can't just market time. So we got out 145, we got out in 141, 142. I'm out. However, I have a limit order. We're getting close to buy again. Like interest rates, these two are very correlated. So it's almost same trade, almost, not exact. So yen is being driven by the politics in Japan. There's some uncertainty and an election
in a couple
October
of days,
27th.
Right? Yeah.
And leading into that election, there's weakness building. Plus, the Fed not cutting as fast. So the interest rate differential of BOJ not being able to hike as fast because they're worried about disrupting the carry trade or causing more volatility to Japan and the rest of the world. Plus, if Fed cut aggressively, the yen would stay put. But Fed's not cutting, they're not hiking, so the differential between U.S. interest rate and Japan remains wide and may remain wide depending on Japan election and the Fed decision. So all of a sudden, yen's running again. Remember the last peak was 160, 162? Right. Today we're at 153 and we're kind of catching the falling knife a little bit for the day. I say my first limit order is 154. It's not exact because I trade FXY and I put a $60 limit order. I think that translates to 154. It was not a magic number. I picked a round number called 60, okay, rather than I'm a technician trading the yen. And I think it could run up to 160. I don't know if it's going to test the highs of 162, but let's just go round number. It's going to test 160. So what am I doing now that I tell you my style? Put first limit order, and I will probably buy again at 157, which is a technical level. A lot of people tell me, and if it gets to 162, I'll buy. And if it gets higher, I'll buy. Right. Because I think the right resting place for Japan, the yen, is 140, 135, 145.
It's like their natural, natural rate, so it's a great time to buy yen.
And you asked me this as we talked, and so I wanted to put this out there, which is, a lot of people talk about, hey, demographics, Japan economy.
Yes.
So wouldn't it be the yen will likely weaken? I'm all there. So if somebody asks me, where will the yen be 10, 15 years from now? I say 200. Like in terms of big number, 200. But not now. But if you're doubting the 200, why not now? What about the U.S. Borrowing and deficit? From the 70s, a lot of people, the bond vigilante types, like U.S. is going bankrupt. And here we are passing 100% debt to GDP on U.S. Treasury borrowing. And no one's yet worried. We all worry, but we know it's not a equity market. The public markets do not worry about something that could happen in 10 years. It only worries about things that happen in the next month or two to maybe up to 6 months, no more.
We only have a couple of minutes left, and I do want to ask you, because you, in your purview, as you look at certain multi-strategy funds that manage some of the money for you, and briefly, when you're looking, and then what I want to ask is, in case our viewers are looking at maybe smaller funds like that, when you're looking for a fund manager, what are the top things that you look for that convince you that I'm safely putting my money with this guy? Just like the top couple things.
First thing I look at is their fiduciary corporate responsible behavior. Okay? I like to make sure whoever I give my money to or allocate my money to is a responsible long-term investor. I don't need a hedge fund alpha. I made this money, I made that money, even though we were talking about money making even on this show. Yes, first you have to have alpha, for sure. But to me, in due diligence process, are you a fiduciary responsible person? Can I let you babysit my kids, kind of fiduciary responsibility, okay? Then comes, obviously, what's your alpha? And a lot of managers will generate alpha through style or selection, okay? If you're a bottom-up stock picker, I don't need you to give me style beta. a star alpha. That's my job as a macro guy. I make asset allocation calls. That's my job. Once I select a box, let's call it the Morningstar box, I want to make sure you're disciplined in generating genuine alpha, consistent. Okay? I don't want you to tilt and then make your alpha from a tilting.
Great.
So anyway, it gets very complicated, but I think this is maybe conceptually the right answer for this moment.
Well, thank you so much for coming on the show. I feel like we could talk for another hour, but that will do it for a Global Money Talk today, live from the New York Stock Exchange. We're so excited to bring you daily coverage here on SamPro TV. You can check out the show anytime on our YouTube channel by searching Global Money Talk. Thank you so much for joining us. We'll be back tomorrow morning. Have a great day.